Welcome to DeFi by Design, where we talk all things blockchain, cryptocurrency, and strive to educate, power, and enrich.
Welcome back to DeFi by Design. I'm Rob. Happy to be talking to you guys today. I'm here with Andrew and Kenton. Andrew, how's it going?
It's going well, man. I'm hanging out, staying alive with Corona going on, so can't complain.
Yeah, same here. Just keeping with it. But really excited to be talking to Kenton today. He's from MakerDAO, and he's been at MakerDAO for a long time. Really interesting project. So Kenton, over at Maker, is an integrations engineer. He has contributed to developing the Maker protocol and is actively working on the MakerDAO ecosystem. What MakerDAO is really focused on is Dai, which is an Ethereum-based stablecoin pegged to the US dollar. It's the world's first global unbiased digital cash, and it's the core feature of the Maker protocol. Kenton's role is focused on improving the integration experience of Dai and pairing it with the Maker Vault functionality into supporting platforms. This stretches from crypto wallets to crypto exchanges all the way across the DeFi ecosystem. Since Dai is the oldest stablecoin in the industry, and this is across DeFi, it's manifested through varying products such as borrowing, lending, prediction markets, and trading, which all bundles into an ecosystem that moves decentralized networks and open source software to improve financial systems through transparent and connectable protocols. Now, a little bit more about Kenton. Before joining Maker, he was actively involved in rocket propulsion systems. He's worked at SpaceX, Lockheed Martin, and a NASA-funded cryogenic lab during his aerospace engineering education. So now he's still working with Decentralized Finance over at Maker. He's a self-taught coder and adventurer. How's it going today, Ken?
Hey guys, everything's going great. Thanks for having me on the podcast.
Cool. Really excited to have you on today. We want to talk about everything DeFi and what you're working on. So we can jump right into it. What is Dai, first of all, since that is the main focus of Maker? How is it better than other stablecoins? And what is kind of the 101 on Maker and what they're doing in the DeFi space?
Sure. I think you had a great introduction into what Dai is. Dai is the world's first global, unbiased digital cash. So what this means is that it's accessible by anyone, ranging from un or underbanked at any time, any place. It could be used to purchase goods and services. It could be transferred anywhere in the world within 10 minutes or less. And it's a stable coin, which means that it's soft pegged to the US dollar. That is one primary use case of the Maker system. And the other one is to grab liquidity. And so this is how Dai is minted and burned. The supply can be adjusted by anyone. And I think before I dive into exactly how that works, I think it's best to do this through an analogy. So in the legacy world, what if you need like a liquid asset like cash? What would you do? So let's put that into some context. Say that you're a small business. You're looking to expand your operations, but you don't have the cash yet. In the legacy world, you would go to a bank, ask for a loan, pledge your business asset as a form of collateral. Wait for a month, go through all these hoops to get your business appraised, and finally you will get your loan. Using Maker and DeFi, you can lock up a digital representation of your asset and give instant liquidity to yourself. And that liquidity is in the form of Dai. So I think that, first is stability, that's in the form of Dai, and then the second is liquidity, and that's in the form of this permissionless loan. I think that both of these are the core pillars of what MakerDAO is offering.
Yeah, I mean, those are two things that I think will be quick for other people to pick up on as well. In fact, I'd be willing to make the argument that the average user of finance would be more willing to invest and use Dai on a regular basis than other crypto protocols, even including Ethereum. Even though, obviously all of this stuff in DeFi is dependent on Ethereum, I mean, I'd be willing to say that I think spreading that awareness and knowledge of what Dai can do and does, along with the Maker Foundation, is going to be crucial for the overall growth of Dai itself in terms of being more liquid, and more trustworthy, right? Because it's only been around for 2 years. It's supposed to break, or it shouldn't break once in every half century, something like that. So I think more like Dai could really be something that brings the awareness of, this whole craze with DeFi, to the light, in the extent of a stablecoin that's effectively not backed just by a US dollar. Got a little off the rails there, but I'm really excited about Dai. And a lot of my friends actually have been asking me about stablecoins recently, less about, cryptos, more about, what are these stablecoin things? How do they work? How can I earn interest? All that kind of stuff. We'll dive deeper into that, but I think I'm really excited to have you here right now.
Yeah, awesome. Dai is one of the world's first true decentralized stablecoin. And so I think it's worth to highlight some of the pros and cons as it compares to others like it out there.
Kenton, could you give us a little more insight into what you do at MakerDAO specifically and, what it's like working for an open source protocol?
Yes, of course. So I work as an integrations engineer at the Maker Foundation, where my focus is on improving the integration experience with the Maker system. I think it's worth drawing a distinction between two commonly misunderstood entities. And so the first one is MakerDAO, and the next one is the Maker Foundation. MakerDAO refers to the set of smart contracts in the Maker system that rests on the Ethereum blockchain. The community, MKR governors, as well as the ecosystem of projects that are built on top of the Maker system. On the other hand, the Maker Foundation, which is a temporary organization that I work for, that is purposed to bootstrap the MakerDAO. So what that includes is laying the groundwork of technology, as well as helping to kickstart some of the governance processes, so that it could eventually live on its own. And I'm sure we can get more into this, but MakerDAO is decentralized because its governance is decentralized as well. So not only can anyone come in and use our system permissionlessly, but then also one could participate in the governing action of ensuring that a system like this remains valuable to those in need.
And is it tough working for an open source system like that? I know you said that the Maker Foundation is bootstrapping MakerDAO. How does that work? Does it come with some pros and cons that you wouldn't necessarily get at a traditional hierarchical job?
Sure. I think working for a foundation in this open sourced ecosystem is quite interesting because the foundation is just one voice, and it's not the only voice. There are other community members and MKR governors out there. And when I say MKR governors, I'm referring to those who hold the MKR coin. That's our governance coin. Basically gives them a share that they can use in the governance process. So working for a company on a project that is not entirely controlled or really more or less influenced by that company means that you have to really know what you're talking about. It's going to be sticky, right? The foundation may have their own provocative of where the DAO should go and evolve into, but the community members and those that hold MKR and that are involved in the ecosystem actually have the most influence in this. And so really, from my perspective, it's been a pleasure working and also thinking alongside of this open source community.
Yeah. And speaking of decentralized and open source, you were mentioning just a bit ago about Dai, and it obviously is the foundational piece of a decentralized stablecoin. Now, real quick, the other two stablecoins that come to mind are USDT as well as USDC, right? So from what my understanding is, essentially USDT is kind of in the middle of Dai and USDC, meaning Dai is not backed by any sort of dollar. There is no one-to-one, as well as it is completely decentralized, right, in the way that it is in existence. And then USDT, I believe, is decentralized, but it is also backed by a dollar. And then I believe USDC is completely centralized by Coinbase, meaning they can freeze the funds at any time, and it's backed by a dollar. So correct me if I'm wrong there. And then what do you think about those comparisons and what makes Dai either better or worse, pros and cons in comparison to USDT and USDC?
Sure. Just for those who don't know, USDC stands for US dollar coin, which is a dollar representation that's minted and burned by Coinbase. USDT, for short, it stands for Tether, but it's USD Tether, and that's issued and maintained by a Tether treasury. And so both of them are actually quite alike. The only difference really is that there has been some speculation that for every USDT that is in circulation, there's less than $1 that actually backs it. And that's most likely because of the lack of cooperation that the Tether treasury has with the outside world. But we can get into that in a second. Let me just give your audience a breakdown of what are the flavors of stablecoins out there. So there are three types of stablecoins. Fiat-backed, which is the easiest to implement. Crypto-backed, this is what Dai is. And then algorithmic, so this is the hardest to implement. USTC and USTT and PAX, they are all fiat-backed. So that means that a centralized entity accepts a fiat currency, locks it up into their bank or one of their partner banks, and issues a digital representation of that dollar. A pro is that it's very simple to implement, but a con is that there's much risk that the counterparty, aka Coinbase or the Tether treasury, will not follow through on its word of dollar redemption or some other form of corruption takes place.
Right. So real quick. So essentially, if there was an incident like a bank run, this could be a potential problem with the fiat-backed stablecoin.
Exactly.
Okay.
So Coinbase is under the U.S. jurisdiction, and so there's likely larger regulatory scrutiny on their operations, whereas Tether is actually operating outside of the United States, outside of Europe, and they're actually, I don't even know if they have a headquarters somewhere. So they are a remote organization and thus likely do not have the regulatory scrutiny that Coinbase has. So in the event that there's a massive run on dollars locked up in the Tether treasury, there could be a bank run type situation where there's a race condition leading to those that arrive late actually don't have any dollars to then redeem. So
how does Dai come about to solve this problem of the redemption and of the bank runs and of everything that we just talked about?
Sure. So unlike fiat-backed stablecoins, Dai is decentralized. So that means that not only the system is permissionless, but also the governance is open and accessible for anyone to help to contribute to. So what that means is that Dai is not created or redeemed by any central third-party gatekeeper or a group thereof. And it's always backed by a surplus of a pool of diversified assets.
And Kenton, we've talked before about how different coins have different collateralization factors. Could you go over kind of how those collateralization factors work and the difference between under-collateralized loans and over-collateralized loans? Kind of how, these coins, some people, they can post collateral and then get some sort of loan in return, but they can't go over and above. So, for instance, with a decentralized organization, there is no credit and you can't get any kind of loan that would go, over and above the collateral that someone would post. Why someone would do that, what's the benefit for that in certain kinds of lending aspects?
Sure. So lending and borrowing as it exists on the Ethereum blockchain right now is largely going to require some form of collateral that backs the loan amount in the event that the borrower defaults. And so why is that important? Well, everyone that has access to the Ethereum blockchain has an Ethereum address, and the Ethereum address is typically not linked with a real world identity. And even if it was, they could be anywhere in the world, and they can fall under any jurisdiction that actually may side with them over the lender in a potential litigation. And so that's the reason why there's a collateral requirement for borrowing and lending in DeFi on Ethereum now. And so when you think about how much of an asset should be required to back a loan, you typically think in terms of cushions. So in the event, let's look at a potential default of some sort. In the event that a system suspects that a borrower will not be able to pay back their loan, be it on Compound or the Maker system, it will liquidate their position and sell off their asset in an auction in order to essentially cover that bad debt. Okay. And so the reason why that the concept of a cushion is important, and this cushion, it's called collateral factor. That is terminology used in the compound system. But in the Maker system, it's called Collateralization Ratio. And so that is essentially the USD value of collateral that backs the USD value of the debt that is owned by a given borrower. Okay. And so if you have a really high collateralization ratio, then the system is pretty confident that you haven't defaulted on your loan and that eventually you will pay it back. But in the event that that collateralization ratio starts to go down, then there's going to be a point, depending on which system you're looking at, where your position is going to be liquidated. And so for our system, for the Maker system, the liquidation ratio for Ethereum is 150%. Okay, which means that for anyone who opens up a loan position, if the underlying asset decreases in value below that point, their position will be liquidated.
Got it. Yeah. So what are some of the reasons that someone would take out an under-collateralized loan, or an over-collateralized loan? Because we know, when someone needs money or they need credit, that would be, I guess, the most common reason for an everyday individual to be taking out a personal loan. What are some of the reasons to take out over-collateralized loans in this instance?
Sure. So in addition to the kind of like the design requirement of Ethereum, whereby you can't really avoid this anonymity expectation. Other than that, where you don't know who you're going to operate with, it actually gives you a faster ability to take out a loan if you have an asset that can be properly valued and verifiably locked in a system like the Maker system for a type of over-collateralized loan. And so again, it's really just speed and access. You can be anyone, someone who has great credit or someone who does not. If you do not have great credit, then this would be your best option. But if you do, you are still going to be constrained by the amount of time that it takes to evaluate an under-collateralized loan. And for those who aren't as familiar with what an under-collateralized loan means, it's essentially a loan by a lending or financial institution that doesn't require an asset to be locked up, and that can be used to cover that loan in the case of default. And so what they typically look at is the potential cash flow that would come from your income, right? And so they evaluate who you work for, what are your costs, what's your monthly income, and then look at your credit score as a way of reputation to then calculate a rate that is conducive to the risk profile that you fit into.
Interesting. Yeah, I found that as one question that kind of stuck in my mind, going through these DeFi protocols, and MakerDAO, was also part of this under-collateralized versus over-collateralized lending question. So thanks for kind of giving me a clearer picture on that. That's one thing that comes to mind when I think of how DeFi could improve or give more accessibility, would be to, provide more loans or incentivize more loans that are under collateralized, because that would be, where more people need help. They're trying to get out loans. Are there other problems that you see now that need to be solved before average people are willing to convert, from their traditional fiat currencies over to a stable coin like Dai?
Sure. So the two biggest issues that we're seeing in DeFi right now that's preventing people to convert the traditional fiat currency to a stable coin like Dai is that the Dai peg, which is basically saying what is the US dollar exchange rate of Dai, the Dai peg is currently not at $1. So ever since March, there has been a constant, kind of like a perpetual state of more demand than supply for the Dai coin. And so what that has done to the Dai peg is it has increased the exchange rate to like 1.01 and $1.02. And obviously from a consumer's point of view, it doesn't make sense that you're going to exchange from like $100 into less than 100 Dai. And so I think that that will add some confusion and ultimately inhibit the amount of Dai demand from traditional fiat owners. But I think it's important to recognize that, again, this problem is being addressed by the MKR governors and the maker community. It is something that's front and center in terms of the problems that we have to handle. And so there are multiple proposals out there that attempt to fix this issue through the form of increasing the debt ceiling on some of these assets to the potential new type of module called the PSM.
Nice. Yeah, no, I can only imagine actually working right now with all of this stuff that is going on in DeFi and trying to be at the forefront of solving those problems that you just mentioned and trying to bring people right into this world of decentralized finance. What has it been like currently with everything that's been going on? It seems like this whole sector, if you will, has really blown up, and it's getting to the point where people are getting really, really excited about this. So, I mean, starting with like the Compound protocol, obviously with market cap or valuation, if you will, of over 2 billion, and all these other platforms. You got InstaDeep and Uniswap and Balancer and all this kind of stuff. What do you think, and what's kind of your take on what's been going on with the recent rally in DeFi, with the yield farming and liquidity mining on Comp and Balancer, and just overall kind of what's been the vibe with your peers and coworkers amidst this growth that's been happening and seeming like, towards the end of this year, it's only going to keep on growing. How's that been, and kind of what are your thoughts right there? I know that's a lot to unpack. You can take it in whatever direction that you like.
Sure. I think that our space is going through another craze, right? It's similar to the 2017 ICO craze, but it comes in a different form. And this form is in the form of yield farming. And so what yield farming is it's the opportunity for people to participate in DeFi systems and be given an incentive for that participation. So that's the most abstract way to kind of introduce this. But what we have actually seen, like more concretely, is protocols like Compound and Balancer basically offer subsidies for adding liquidity to their decentralized systems. In the context of Compound, this is a money market protocol on Ethereum, aka that means you can borrow and lend on open terms. Again, wrapping it back to earlier, this type of system requires that collateralist pledge, so it's also an over-collateralized loan. But what Compound is doing is they have actually locked up almost half, like over 40% of their Compound governance token called Comp. They've locked it into the system, and that system is distributing Comp at about like almost 3,000 a day, right? So if you multiply that by the market price of Comp, which is about almost $200 a day, then that's equivalent to about $500,000 worth of subsidies every day just for parking your assets on the Compound system. And so when you compare that to the amount of incentives that Compound offered previously, which was only like between $10,000 and $20,000 worth of incentives in the form of interest, I think that it's fairly easy to understand that we are going through another rally. And it's not only a rally in price and new projects, but it's a rally in innovation. Yes, this type of subsidy program is not new. I think a while ago, either JetBlue or Jet.com in like 2012 or 2014, they offered something similar where they said, look, we have 100,000 shares. If you refer someone, then you will get a share, right? It's not new in an overall sense, but relatively, if you look at the blockchain space and specifically the DeFi industry, this is a brand new type of experiment, really. And that is what's very exciting. So what I'm thinking when I observe all this is like, holy crap, I didn't even know that. Like no one could have predicted that the price of Comp would be where it is right now. And when it was initially added to a Uniswap pool at the time of Comp to distribution, it was like $30 or $40. And so the price has 5x, and that has led to very like strange types of like inorganic behavior from the user base. And so I'm trying to stay like conscious of that and just focused on the innovation part, because the systems and processes that come out of this craze, if it ever comes down, is going to lay the groundwork for what decentralized finance is going to evolve into.
And that's really interesting, just kind of what's been happening with Comp and how we saw the price run up so high when it was actually trading at $30 or $40, like you said, for quite a long time, and then, had some rapid growth. One kind of offshoot, and you talked about the governance of Maker, but also of Comp. When this protocol is distributing so many governance tokens per day, is that a problem? Do you think there's too much governance power falling into the hands of people that, don't actually care what happens with Comp and where the protocol goes? I'm not sure if you've seen kind of the governance statistics on Maker or Comp. I'm not too familiar with them, but what I did hear was that, a lot of these governance token holders don't actually vote on proposals. And to me, that seemed like, a really deteriorating aspect of the growth that we're seeing in DeFi. Can you speak to that? Do you see the same thing? Ultimately, is this just a short-term problem that'll get solved? Kind of, what do you think on the governance side of things?
Sure. So the compound distribution plan had two goals in mind, or so it seems. The first one was decentralized governance, right? If we're going to promote a system that is governed in a decentralized way, we want to ensure that there's a large distribution of ownership across the spectrum of those who use this system, right? And what better way to distribute that compound than to actually reward those that are interacting with the system on a day-to-day basis? So that's the first goal. The second goal is liquidity. So what happens when more assets are parked in compound is the slippage on these loans and trades is actually reduced. And so actually and I think this applies more to balance or more than compound, but it just more or less just improves the value proposition of the compound system once more assets are under the management of the compound protocol. So I think you're right to speculate that the compound farmers that are capturing compound dividends, if you will, are not as active in the governance process. I think one could agree with that, but I think it's also important to remember that this is simply a function of the comp price. And this is not intended, but I think that as more and more compound is distributed through the system and comes down to the market, the float is going to increase, and that's going to have a downward pressure on the comp price. And once the comp price leads to an annual yield of less than the 68% amount that we're seeing now, and it comes down to 10% or 5%, then I think that the farmers that are dropping their assets into a compound to secure that compound distribution, they are going to be more focused on participating in compound governance. So I think we'll see what happens with the price, of course, and the future is unknown. But if the comp price comes down, I think we will see a higher proportion of compound users that are going to participate in governance.
Interesting. Yeah, I would think so too. I mean, just watching what's happening with these different governance protocols is kind of like a big political experiment, and we're doing it in cryptocurrency, which I think brings a lot of things together. Andrew, were you going to go ahead and say something?
Yeah. So I don't view that as a huge downside, but it's certainly something that we have to be aware of. But I'd like to just touch on some of the downside risks that are prevalent right now with this DeFi rally. So, aside from, prices going down, if you're buying on speculation of a lot of these DeFi assets, which are on average, I believe, up about 100, 200% in quarter two, I would expect that to honestly, I have no idea what's going to happen there. So obviously, investing in cryptos itself is a downside risk because, price could go down, you can lose the value of your tokens. But I'd like to touch on the other downside risks, kind of what you see, Kenton, that some problems and some risks that have been uncovered recently, all right, with this craze. Obviously, there was balancer, quote unquote, hack, right? There's obviously the smart contract faults and bugs and a few other things, but I'd like for you to touch on that, if you will, and just kind of educate us as well as the audience on kind of what the downside and the risks are, whether it's technical or emotional or protocol risks, just what kind of risks we should watch out for when trying to yield farm or use these platforms or invest. Obviously everything we discuss here, as said, is strictly educational, but as far as risks, what can we expect with these protocols?
Sure. I think when you look at like Web 2.0 and you look at the Facebooks of the world, the Amazons of the world, etc., they have been very successful in adopting an ideology which says like work fast and break things, right? And so what that means is let's really grind out new innovative technologies, and if it breaks, then that's fine, we'll just patch it up. That I think is not as applicable in Web3 because we are dealing with real value that can be lost. If things break, real value can be lost. And so I think that the systems and decentralized protocols of Web 3.0, they need to adopt a different type of mentality that prioritizes security and promotes scrutiny among everyone. And so we have seen a lot of the largest players in the space, including the Maker Foundation and Compound Labs. We've seen that like both of them have prioritized that over everything, even usability in some instances. But I think it does not ensure that the ecosystem is immune to smaller teams that have smaller, that are almost startup-like, and they don't have as many resources to formally verify their smart contracts, right? Which is another word, like it's like a mathematically like proving operation of the smart contracts. They don't have those resources to perform such large amounts of scrutiny. And so we're going to see issues, and we're going to see hacks, and we're going to see projects that continue to work a little bit faster than I think is necessary. And so when you're looking at DeFi systems out there, I think that one could count on both of their hands the number of examples of DeFi systems that have fallen prey to like a hacking event or exploit. And I think we're still going to see those as the space grows. And it really boils down to the technical risks, which is like if a smart contract system does not have like a formal audit, then it has a higher risk of having a smart contract bug. And then the other one, which is what we're seeing right now, is the economic like risk. Like the risk may not be evident up front, but it actually may be lurking behind the curtains. And that comes from just strange incentives and strange responses that come from brand new incentive structures. So what do I mean by this? I'm referring directly to compound and the compound price. Like we have seen that the compound price, the volatility of that has been huge. And that's because there's so much interest and so much like game theoretical like responses that's happening right now. It's really hard to predict what risk can come out of that. So I think those are the two big risks that people need to be aware of, but to also recognize that like, look, this is going to continue to happen, and that every additional hack that happens, there's going to be like a rebirth that occurs where people are going to improve their processes and there's going to be more innovation long term. So I think it's almost like a rite of passage, I feel, but I think that could be a bounded opinion.
And Ken, how is MakerDAO working on improving these risks? You know, like each time you said we get hacked and then we see a rebirth. How is MakerDAO anticipating these game theoretic responses? And what do you see coming up for MakerDAO that's, you know, trying to improve the system overall?
Sure. So the MakerDAO and the foundation, we've been really focused on iterative improvements, right? And so from a usability point of view and like a market research point of view, the first like maker system that was released was called single collateral Dai. So what that meant is that Psi, and it's Psi for short, Psi could be minted and burned, but only with the Ethereum asset, right? Whereas now Dai is backed by like 6 or 7 or 8 different asset types. And there's an important like distinction there. As you increase the amount of assets that back the value of Dai, you effectively diversify the tail end like black swan risk that occurs from a single asset. And so Psi in itself actually ran for almost 2 years. And what we found, like through that, we were able to build our governance processes. We were able to better understand how Solidity contracts work from a fundamental, like primitive point of view. And so building the prerequisite knowledge and understanding what's the best use case of our system was accomplished with Psi. With Dai, first and foremost, security has been the most important thing. In addition to our internal reviews, we have 3 separate formal audits from 3 professional auditing and security firms. And we have formally verified all of our core contracts. And when I say formally verified, again, I mean that it's similar to a mathematical proof, but it's proving the actions of a set of smart contract logic. And so I think that like the formal verification has been the like almost the final stamp of approval in the smart contract space. And so that's how we handle those risks.
Cool. Yeah, I think that's really interesting on how you guys are still developing, especially with the way that the DAO, because it's autonomous, and what it prioritizes and what it decides to work on and when. I think I have, just one last question, and it is kind of forward looking. I'm curious, when competition really boils down the interest rates and the liquidity farming, what do you see as the benefit in decentralized finance compared to traditional finance when, ultimately we might see those rates as far as comparable percentages? And, you can keep it quick because I know we're running out of time, but what are you anticipating for that?
I think that traditional finance has a lot of like fat on it, if I'm being frank. And that fat comes in the form of cost, time, and a lack of accessibility. And with decentralized finance, which stands on the shoulder of the Ethereum blockchain, of blockchain technology, anyone now has access to the traditional finance services such as borrowing and lending and prediction markets and insurance at a fraction of the cost. And they're able to make use of these systems at the fraction of the time that it would take. I think people take it for granted, especially in the West, because there have been many abstraction layers that have been built on top to make finance look easy and pretty straightforward. And they have been, right? But underneath that abstraction, it's still ripe with roadblocks. And with decentralized finance, we could finally fix those roadblocks once and for all.
Awesome. Yeah, and I'm looking forward to it.
Yeah, I mean, it's already grown. I think 2021 is the year where the whole world wakes up to the fact that while everybody once thought that cryptocurrency was kind of dead again, right, with the 2017 pump and the Bitcoin this, and everyone is still focused on Bitcoin, what they're going to realize is that there have been just a mass amounts of development on the Ethereum blockchain with Ethereum as the contender here for the great flipping and all this other stuff. And I think even like the centralized, like the finance bros, even like the suits, quote unquote, as Dave Portnoy would call them, I think they're going to come to realize like, wow, there's like almost a parallel infrastructure here that we've just have no idea about. And I think 2021 is going to be when that is all coming about. So I think, overall, that the outlook is certainly great for, this space, this sector, and being here. And yeah, Kenton, that's all I've got for you as well, man. It was a serious pleasure having you on. Your knowledge of Maker and Dai is obviously top notch, well versed. It was a pleasure. And is there anything else that you'd like to share with us or with our audience, or any closing remarks?
Yeah. I'd like to also say thank you both so much for giving me your time. It was really fun to have this type of conversation. And for those that are more interested in decentralized governance, you can go on to forum.makerdao.com and actually see decentralized governance in action. And it's also free, right? Like anyone can participate in this. If you have any more questions for me, you can reach out to me on Twitter at Kenton Prescott, first and last name. DMs are open. But thank you both.
Thanks, Kenton. I learned a lot, and I hope everyone who listens learns as much as I did. So thanks for having us, and I hope, again, we can do this again sometime when DeFi has 10 billion locked up. We'll do the next one.
Awesome.
All right, guys. Well, this has been DeFi by Design. Thanks to our guest for coming on today. That was Kenton Prescott. You can find him on Twitter at Kenton Prescott, the integrations engineer for MakerDAO. So I'm Rob, and thanks for listening. Bye, guys. Thanks.
Thanks for listening to the DeFi by Design podcast. Until next time, DeFi Slate Team.